the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're listening to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started. Well, Singapore shares opened nearly flat this morning as global markets recorded declines overnight. So in early trade, the Straits Times Index was down 0.02% at 3,926 points. After some 64.7 million securities changed hands in the broader market. Now, the STI closed roughly flat today, so let's take you through the closing numbers. So STI closed up 0.06% at 3,929 points. In terms of value turnover, we are looking at 1.73 billion Sing dollars. Now, gainers trailed losers though, 270 versus 277. Top advances for today, we've got here DBS, GMHUSD, Semco Industries, and top decliners, we've got here Shangri-La Hong Kong Dollars, Wilmar International, and Seatrium. Now, speaking of Seatrium, it is one of our counters to watch for today because the offshore and marine specialists swung into the black with a net profit of 120.9 million Sing dollars for the second half ended December to mark its first full-year profit on record. Now, elsewhere, from what high-level discussions between Washington and Moscow on the war in Ukraine mean for investors, to Alibaba surging 11% earlier on the back of forecast-topping sales figures, we've got more international and corporate headlines in focus. And joining me on a Friday, as always, is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, welcome.
Hi, how are you?
Good. And Ben, let's start with global markets this time around. The first high-level discussions between Washington and Moscow since Russia invaded Ukraine without the presence of Europe or Kyiv, that saw the two appoint teams to negotiate an end to the war. Now, that thawing of the US-Russia tensions, that led to angry exchanges between Trump and Ukraine President Volodymyr Zelensky. Also, out of the U.S., disappointing earnings out of Walmart. So a lot of things surrounding the U.S. in particular. How are investors reacting to the flurry of news?
Well, I think we need to take a step back and remember that the S&P 500 has really been on a fantastic streak, having topped 25% for the last 2 years. And 2025 is probably going to be positive, but it's going to be a little bit more muted compared to the last 2 years. We could actually be in a later stage of the bull run because based on the retail fund flows information, we have got a lot of retail investors who are coming back into the stock market, and historically speaking, when there are too many aunties and uncles jumping in because of FOMO, fear of missing out, that's when it's kind of time to turn cautious. Now, as you have already mentioned, there's quite a lot of anxiety surrounding Trump 2.0, so it's not really surprising that the gold has had such a good advance since the beginning of the year. Its forecast for the rest of the year is actually quite bullish. If you look at the technicals, gold is still very much in ascending price channel. Its advance could actually be a little bit too much too soon, so a short-term pullback might be possible. But I think what we should do is, of course, be prepared for more volatility, and investing in gold is not a bad idea given that Trump 2.0 is still working out its kinks.
Okay. Now back to the Singapore stock market as usual, Ben. How did the STI fare today, given also a slew of earnings that came up from notable names, including Wilmar International, SIA, Genting Singapore? We will talk about Seatrium in a bit, so just hold on to your thoughts. But any of the companies, Wilmar, SIA, Genting, stood out to you today? I mean, quite a bit of movements relating to Wilmar. Once again, any thoughts?
Well, I think we can focus on Wilmar because the stock price was hammered down 4% at closing. But if you take a look at the numbers that came out, it's not all bad, though. If you look at the top line was about flat, a positive growth of 0.3%, a bit of a mixed bag. But what was interesting was that its second half revenue showed strength in its food, feed, as well as industrial products. I think what really hurt the company was weak margins in the sugar merchandising as well as tropical oils. But what we need to remember is that, Wilmar is in the agriculture and commodities business. So depending on the cycle, sometimes it's going to be great, sometimes it's not. So it's all part and parcel of the game.
Now, zooming in on Seatrium specifically, Seatrium swung into the black. We're looking at a net profit of close to 121 million Sing dollars for the second half ended December, which is a reversal from that net loss of 1.8 billion Sing dollars that we saw in the same period a year ago. Now, together with the H1 turnaround, Seatrium marked its first full-year profit on record since 2023. What do you think is the road ahead for Seatrium then? Again, if we look at shares, likewise, like what you mentioned about Wilmar, shares were down over 5% for Seatrium. So are investors' reactions once again justified then?
Okay, so Seatrium is, again, one of those classic situations where, we investors need to be patient, not our strong suit as Singaporeans. Now, again, looking at numbers, the company's order book is quite robust, actually. So, and that provides a very good visibility for its revenue and cash flow for the next few years. If you look at the financial targets for Seatrium for right until 2028, the company is actually progressing quite well against those financial targets. So it's actually all on track. If you look at the consensus target price, and you compare that versus today's end of day price, there's still quite a healthy 12% upside. What is interesting is that the company's price to the book is at about 1.4, which is relatively low compared to its historical average, which, the traditional or conventional thinking is that this company is relatively cheap. Now, Seatrium has always had this problem that, it doesn't have the same level of sexiness as, companies like Apple, Nvidia, Tesla, or Bitcoin, right? So the price performance is always going to be slow and steady. There's no two ways about it. So, but as the wise men say, all good things come to those who wait.
Okay. Now, if you're just tuning in, we're now in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. Well, across the region, Ben, Hong Kong led gains today, soaring more than 2% earlier. No surprises there on the back of an 11% surge in Chinese e-commerce titan Alibaba in the wake of forecast-topping sales figures. I believe it closed around 14% higher, was it? How would you read into Alibaba's latest earnings, and what can we then expect from other Chinese e-commerce players like your JD.com?
Well, Alibaba has got a few unique catalysts going for it. So the first one is that it recently released its latest Qwen 2.4 Max Edition AI model. And, depending on the AI benchmark testing, you actually beat out Meta's Llama as well as DeepSeek's AI model. So that's all great. The second thing is, of course, the recent news that Apple and Alibaba are tying up. Apple is going to offer Alibaba's AI model for iPhones sold in China. So there's going to be a game changer for Alibaba. And this is a huge win for Apple itself, simply because Apple is using ChatGPT for its Apple Intelligence in all other regions. But access to ChatGPT is blocked in China. And the third catalyst is that, that one photo with President Xi Jinping and Jack Ma and the rest of the billionaires.
Yes.
That one photo basically offered Alibaba as well as the entire Chinese tech sector absolution. So they have been forgiven, and it's all hands on deck, and it's going to be good for them going forward. So the impression there is that the regulatory scrutiny that has been going on in the tech sector for the last few years, that's going to be over, and technology in China is coming back as a pillar of growth for China. And of course, the last one is obviously Alibaba's latest earnings, fantastic numbers. So it all points to the fact that Alibaba is in a very good place right now, and it's going to this is going to be a good benchmark or good baseline for them to move into the next stage of evolution. Now, if you look at JD.com, yes, all those other companies are also in the tech consumer retail sector. But one thing they don't have is, of course, the tie-up with Apple.
Yeah.
So they are going to benefit from the uplift from the overall, positive sentiment in the stock market as well as the tech sector. But they don't have that Apple secret sauce. So I think Alibaba is probably going to be that's a good one. Yeah, that's the Apple sauce. Yes. So I think Alibaba is probably going to be the first among equals. Until such time somebody else comes up with another tie-up with a big brand company.
You've got me hungry at applesauce, Ben. So let's stay in Asia and let's talk bubble tea, because China's largest bubble tea and drinks firm, yes, I'm talking about the one with the snowman Mixue Group, is seeking to raise 3.45 billion Hong Kong dollars, or around 592 million Sing dollars, in a Hong Kong IPO. Now, if I recall, Reuters previously reported, citing sources, that Mixue earlier planned to raise up to $1 billion USD in that Hong Kong listing, but that size of the share sale was actually pared back or scaled back because the company wasn't in a desperate need to raise cash. How would you read into the change, though?
I think it's actually a smart move to list the company now, simply because of what's happening in the overall Chinese stock market and Hong Kong market. So you have got the positive sentiment, and you also have got renewed interest in Hong Kong listings. So already I think there are 4 IPOs year to date, and we're only in February in Hong Kong. Even though the company doesn't need cash, it's probably a good approach from a timing perspective. So this is kind of the classic strategy, as opposed to listing in the middle of a recession. So when the market is hot, you try to get your company public. And I think it's all good, because the company can use the excess cash as buffer, or you can use it to accelerate their expansion plans. Already the company is saying that they're going to use it to build more production facilities, expand production, as well as for the marketing efforts. And all these investments right now are going to benefit the company's growth in the long run. And also, if you again zoom out, companies in the business of mala, xiangguo, and pao pao cha, they're all having their day in the sun.
Yeah.
It's like once every few months there's going to be a new billionaire minted because he owns a pao pao cha kind of franchise.
Okay, pao pao cha means really bubble tea, and mala xiangguo means the spiced stir fry. For our listeners,
exactly, yes. The thing I had for lunch today, yes, the good stuff. So if you think about it, it's really as good a time as any to list, even though they don't need the cash.
Okay. Now, finally, before we let you go, Ben, Standard Chartered said it would hand back $1.5 billion US more to shareholders as the reported fourth quarter earnings that beat estimates. That's boosted by, of course, a strong performance in its trading and wealth business. How far was that within your expectations? And speaking of which, I just want to mention in passing as well, Trust Bank announced today that it has reached 1 million customers, making it the 4th largest retail bank in Singapore by customer numbers. So any thoughts on that as well?
Well, I think without a doubt, it is a very good set of numbers for Standard Chartered because it beat both earnings as well as revenue estimates. So the news flow, focus a lot on earnings, but actually, we as analysts, we like both, simply because earnings is an accounting item. There are actually smart ways to kind of make the numbers look good, but it's very hard to artificially boost revenue. So it's great that the company, beat both sets of numbers, right? Now, again, unpacking into the numbers itself, what I really liked was that there was fantastic growth in the wealth management segment that was really stellar. And I like it because the wealth management sector to us is what we call the AUM, or asset under management business. And this is really where a company or a bank like Standard Chartered can differentiate itself with great customer service and really unique products structured for their own special clientele, right? So it is opposed to more generic business lines like trading commissions or IPO mandates, because the kind of businesses are very sensitive to the whims of the stock market. So the stock market is in a bull run, yes, trading commissions and IPO mandates will be fantastic, but it's a very cyclical business. And the last point was that, and really this is the icing on the cake, was that in order to beat both earnings and revenue estimates, the company did not really escalate its costs. So its growth was actually in line with market expectations. So that's all good. So i.e. really means that the margins of this bank is improving, and that's really one way to accelerate the price advance. I mean, that's really a good takeaway for shareholders. So the overall impression is that the bank has a well-articulated plan, and they are executing their plan pretty well. So it's all good.
I see. Lots to watch indeed, and thanks so much for the insights, Ben. And of course, you've given me a dinner idea, mala xiangguo spiced stir fry. That was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.